I'm going to be talking to Professor Gregor Semieniuk, Assistant Research Professor at the Political Economy Research Institute and the Department of Economics at the University of Massachusetts Amherst, and co-author of a very interesting article or paper entitled Stranded Fossil Fuel Assets Translate to Major Losses for Investors in Advanced Economies. So welcome to the interview, Gregor.
Thank you. It's a pleasure to be here.
Well, maybe we could start with just a brief overview of your study, please.
Yeah, sure. So basically, what we're doing is we're comparing the demand and supply for oil and gas under two different scenarios of the future that we calculate using an integrated assessment model, of which there are quite a few that basically try to develop plausible futures of the economy and the climate, with the usually the energy module being a very articulated part of the model, lots of different technologies, lots of technology options and so on, all the fuels, fuel supply and so on. And what we then do, which is I think quite innovative already, is to say, well, look, how much profit does each of these scenarios actually generate for the oil and gas sector? And actually at what asset? Now, we combine this integrated assessment model with the Rystad data, and this may be pronounced actually differently. Rystad, it's a Norwegian energy information company, basically. So we're using their UCube data set to locate all the global oil and gas fields, calculate profits under, basically the difference between the oil and gas price and the break-even price of producing these under each scenario. And then we're just saying, well, look, suppose investors were investing into these upstream oil and gas assets under the first scenario, which projects, pretty sanguine demand, sort of along the lines of what some oil companies are projecting if you look at their annual reports. And we're actually using the projections from the International Energy Agency 2019 current policy scenario. So that also translates into about 3.5 degrees Celsius global warming. You can do the conversion to Fahrenheit for me, but roughly, almost 7 degree Fahrenheit warming. And then the other scenario is actually leads to about 2 degrees Celsius global warming. And we get to this not by stipulating a 2-degree limit, but basically by tracing what happens if oil importing countries, notably the European Union and Great Britain and Eastern Asian countries, Japan, South Korea, and China, are really doing what they're saying they're going to do, which is to go to net zero by 2050 or 2060, net zero emissions of greenhouse gases, or in the case of China, CO2 emissions. Okay, sorry, this was already pretty long, and I haven't really gotten there, but please interrupt me, yeah.
Well, I have a question for you. What happens to prices when there's a small change in demand for oil? Because we saw in 2014, 1.5 million barrels a day of oversupply crash prices. Sure. And so if demand begins to decline after 2030, as many forecasters, including Bloomberg NEF, just released a study yesterday that showed 25 million barrels a day would be lost. But I guess the point here is, if prices crash with only a small decrease in demand, then how does that affect the stranded asset scenario?
Yeah, sure. That's a great question. And if I knew the answer, I would probably a speculator making a lot of money. We are basically taking a long-term view, and we do not model short-term fluctuations in oil and gas prices. What we do, however, is we model sort of the long-term changes in oil and gas prices. And we are seeing a long-term decline in these prices, basically exactly as you're saying, because the market is sending a signal to suppliers that there's too much oil and gas in the market, so that the most costly producers, basically the ones sitting all the way at the top of the marginal cost curve, are stopping their production so that supply and demand are balanced. And just to go back to this initial story, what we then basically do is we see which of these assets become uncompetitive. They stop producing relative to the more sanguine demand scenario. And we then ask, well, who owns these assets? Who's actually taking this hit? Who is sitting on this risk of a stranded asset? And we do this in 4 stages. We go from the oil field, stage 1, or gas field, tar sand field in Canada, to the oil producing company. Then we ask, who owns the oil producing company, which is going to be the immediate shareholders, but there may also be more remote shareholders. Say there is some financial company having a stake in maybe I know Suncor, for instance, and then Suncor and then that financial company, might actually be a Canadian bank, for instance, that has some equity exposure. We're not looking at debt. And then there might be an asset management company having a stake in that bank, right? So that's our stage 3. What is the ultimate corporate owner taking the hit if there were to be stranding? And then at stage 4, we're asking, well, whose funds does the asset management company invest? So actually, fund managers is a bit special because they don't hold their funds on their balance sheets, so they never see these hits to their own assets. But if it's any other company that has it on its own balance sheet, we trace the loss, the propagation of the loss through the balance sheet. In the case of fund managers, we're asking, well, who manages the fund at this stage 3? And then, well, whose funds are here being managed? Is it Canadian pensioners, perhaps? Is it the Norwegian government investing through its oil wealth fund, something like that?
Now, for Canada, and we'll talk about Canada, and then we'll talk about the United States. The losses for Canadian investors, you calculated at $100 billion. That's a very large number.
Well, yes and no. I mean, it's a very large number in absolute terms, and for us as individuals, it's hardly imaginable what that means. Of course, compared to the revenue of the oil and gas industry, or global GDP or Canadian GDP, it's not that big. But absolutely, it's a huge number. And what I want to stress here is that in this study, we did not ask the question, which many people would ask us, what about financial market instability? We do not do this. We just trace the losses. And so it's a big number. But if it just hits a bunch of people that are invested well, they're losing a little bit of their wealth. They have other investments, and that's it. But once you're looking at debt and financial market interconnections, it's a different question. The one thing I will say, though, is we're only looking at upstream oil and gas, right? There could also be a devaluation in other sectors, for instance, those that we're going to use all of that oil and gas in a future where you mentioned the electric vehicles are somehow not displacing internal combustion engine vehicles. And so on and so forth. Perhaps, now people are talking about low carbon steel, which is perhaps more of a problem for coal, but all of these sectors are undergoing a transformation.
Now, Gregor, one of the arguments we've heard from the oil and gas industry in Canada is that it is competitive at lower demand numbers. So they often point to the International Energy Agency net zero transition scenario and say, look, even if there's only 40 million barrels a day, down from 100, there's still demand, and we're competitive at that number. So when you're calculating stranded assets, how do you take into account whether that particular sector of the industry is or is not competitive?
Yeah, that's a great question. As I already said, we're looking at the Rystad energy data, and there we basically get our estimates of the break-even prices for all of these different production sites. Now, and basically the highest cost ones are going out of business. There's a little bit of nuance. We're also assuming that once expectations have adjusted to this lower permanent demand world, low-cost producers will actually step in and try to capture the rest of the market. And I think you did an interview with my co-author, Jean-François Mercure, a few months ago for our companion study, where we're looking very much at the macroeconomics of this. Whereas here we're focusing more on the wealth owners or the stranded asset owners financially. But indeed, I mean, Canada happens to have some of the highest cost assets in the world that are currently producing. And so they are among some of the first to leave the market. Now, we are looking at one alternative scenario, an alternative realignment of expectations, as we call it. And there, we're basically assuming that low-cost producers, mostly in OPEC member countries, for some reason decide to not increase their market share, whatever the size of the market is. And in that case, of course, a country like Canada actually reduces its stranded assets by, well, I'm just looking at the data here, about 10%. So if you look at our article where all the figures are and all the underlying data points under the figures are also available, open access to everyone. I think you're going to link to it in the show notes. Yeah, you can look at these precise numbers, but actually, Canada does not somehow, come out on top. And that's coming purely because of the high cost nature of the oil and gas reserves that are currently being produced.
Now, when you calculated the cost to investors, the losses that they're going to incur, did you also include environmental liabilities? Because this is a big issue in Canada. There are, for instance, the 37 tailings ponds from the oil sands. The reclamation costs are estimated conservatively at $31 billion. So who's going to pay that? If it's the investors, if the companies have to pay, if the investors have to pay, there's $31 billion. Is that over and above the 100, or did you include that?
Yes, that is over and above the 100. We basically only looked at the production costs and the market price for selling those barrels. We're not looking at end of life plugging costs or cleanup costs. No, and that's actually very interesting what you're saying. I mean, it reminds me of the Carbon Tracker Initiative study. I think last fall they came out and they did some estimates around these kinds of liabilities. And this is a good question. Who's going to pick up the bill there?
What about the United States? So the United States is, I think it produces about 12 million barrels a day. They're the world's largest oil and gas producer. Their shale fields have traditionally been high cost. What happens to them under a demand decline scenario, and what are the losses there?
Yeah, according to our calculations, the United States actually sustains the second largest stranding at oil and gas fields on US territory, which of course includes shale oil and gas, but also offshore production. And they then actually move to spot number one, basically because of the financial ownership, via US institutions of producers abroad, but also at what we call stage two, because ExxonMobil, Chevron, and those other large companies have operations abroad. They produce, say, in an African country where they have a production agreement, and they take home a certain share of the income. And so that, of course, all comes onshore, comes back home to the United States in our scenario. And it actually interestingly surpasses Russia, which sustains the largest stranding at oil and gas fields on Russian territory more than any other country. So that's quite interesting, but loses a significant share of them to foreign investors.
Why is Russia affected so significantly? I mean, we can see the effect of the European sanctions already, and well, not just European, but generally the sanctions that have been taken against Russia. Sure. But why are they particularly vulnerable? Are they high cost assets?
Yeah, once again, in our scenarios, this is so Russia is not one of the producers expanding massively because they're basically a high-cost producer indeed. Now, I should say that our data is from 2019. It always takes a little while for an academic study to double-check everything, make sure we're doing it all right, and then there's the peer review process and so on. So all of our data is basically pre-COVID-19 even, right? On the other hand, it's not like everything has changed since then, right? These large investors that hold several % of other companies, they don't just divest the whole thing overnight. So I wouldn't want to vouch for particular companies that have particular investments somewhere, but we're basically looking at broad institutional categories, the financial sector, then we split it up a little bit, pension funds, such things, government, private persons, these kinds of categories. I don't think they have changed dramatically. But yeah, I mean, some of the discussions around companies that are relinquishing their oil and gas interests in Russia, foreign companies, that would change some of the picture of our results if they're going ahead.
Well, Gregor, fascinating insights. Thank you very much for this.
Such a pleasure. Thanks.